Good morning and welcome to the Saxo Bank Morning Call. It is Monday, January 14th, and we have interesting developments over the weekend, especially out of China, the latest trade figures for December. We have a chart here showing the export side of that on the year-on-year percentage, where we have it down minus 7.6%. This despite the fact you're seeing the headlines indicating the largest export surplus to the U.S., and the idea that there's been a lot of front-running of demand ahead of what were feared to be the 25% tariff schedule raise coming into the beginning of this year. So it'll be even more interesting to see the January to February figures as we shift into 2019 here. Although, of course, we have ongoing negotiations, there was a lot of behavior geared towards worrying about the shift in that tariff schedule coming into 2019. Peter, you have some thoughts on the equity market. I mean, the volatility pretty low here, but we have turned a bit lower after a recent rally.
Yeah, we're down almost a percent. It depends on which index you're looking at. If it's the Shanghai Composite Index, it's down almost 2%. If you look at the CSI 300 Index, it's down almost 1%. So they clearly a negative reaction to these numbers in China, and it fits with the, if you look at the chart again, it fits with the overall downward trend you see here in Chinese equities. We failed to firmly break above that 3100 level in the CSI 300, and if the data continues to be weak as it is right now, I would not be surprised to see a new low in Chinese equities. I think we potentially are finding ourselves in sort of a rebound state here in global equities, that it could be a trap.
You've talked a lot about as well the car sales is a big indicator in the Chinese economy, and we have the chart here. I'll just go ahead and while it's still on the chart screen there, showing how European automakers are doing. Of course, at least some decent-sized component of their sales into China, but also domestic car sales in China very, very weak.
Yeah, we as we talked about, John, before we went into the studio, we looked at the change in growth momentum in Chinese car sales. It's the worst since the time series on auto sales were released by the Chinese Statistics Office. That's since 2005. And we know that these numbers are true because we can see the same data among the European car makers releasing data from their Chinese sales. Volkswagen and Daimler and BMW, one of the the biggest sellers of cars into the Chinese economy. So and then every time we see these big declines in auto sales, and typically it coincides with recession. So I would not be surprised to see that China is actually in some kind of recession. Maybe not by the GDP numbers, but at least judging by people's reaction on the street. If you don't buy cars, it's because you have uncertainty about the near-term future. And this chart here on Europe looks very ugly. So you have a weak auto sector and you have a very weak banking sector. So I don't think it looks quite rosy out there. I don't understand the forceful rebound here in equities, to be honest. I think it will.
Well, I've got an explainer there, if you will.
Thank you.
There's a lot of speculation. What has engineered this big rally off the lows? Of course, you could talk about excesses in sentiment. You could talk about the Fed turning around, and as a component of the Fed turning around, in terms of waxing suddenly far more dovish in the communications. There's even the idea that those FOMC minutes were heavily filtered to favor a more dovish impression of what actually unfolded at the December FOMC meeting, which was largely agreed to have been hawkish at the time of that meeting. There's this idea out there that's afoot, FT is actually covering it this morning, that there's some sort of G20 style pact or Shanghai Accord style pact that has gone on where the Fed has agreed to turn dovish and China has agreed to strengthen the currencies. Because of all the negativity you're talking about coming out of China, some indications on the ground of really, at least a very sharp breaking in auto sales, perhaps in economic activity in general. Despite that, we're seeing a stronger currency, and some saying, well, it's just window dressing for these trade talks that are ongoing. Others saying maybe there's some more conspiracy-style pact afoot. So I have I pulled off I did a screen grab of the FT headline on that. If you have a subscription, have a look at that. Have a look at other speculation around that. It's an intriguing idea. I wouldn't completely write it off. And below that, you can see that $CNY, which actually finally bounced a bit late Friday and into this morning. And Kim, I want to get to you in a moment, but I wanted to just briefly, while we're on the charts, Aussie dollar reaching a big technical level. I would argue from the low close, which is the key technical point, around that 72, ahead of that 72.50 area. And Kim, we talked a lot about Eurodollar last week. This you were talking about an ascending triangle, I think you called it, and we were talking about whether or not it's going to break 115. Well, when you get awfully close there and then you have China forcing their currency stronger, it probably helps the dollar to weaken a bit. Clearly some stops will run above that level, but it's reversed back below. So what's your impression here?
Yeah, well, it was obvious to almost anyone that 115 was the level. And we talked about it last week, and I must say, as we discussed, I was it happened. It occurred a little bit earlier than I actually figured. But what we can see, after the break is what it lost momentum.
Right.
So now we are trading back below the 115. And again, we could just be humming away, for the next couple of weeks, actually.
So you think, but does this keep your sort of your ascending triangle in shape, or is this sort of disrupts the whole technicals around?
Well, what we often see when it breaks out of a triangle, whatever kind of triangle it is, or whatever pattern we break out, sometimes we get these pullbacks or throwbacks, what it's also called, that can dent the performance afterwards a little bit. So we should see a break up to above 115 again within a couple of days. If we don't see that, then it's really
bogged down.
Yeah, it is.
That range down.
Yes.
Okay. And then while we're on the charts and talking technicals, and it's also Peter's area, the whole S&P 500 resistance heavily discussed. This 2,600 area is pretty profound in terms of resistance.
Yes, we talked about that last week also. 2,627. There's some resistance there. That is 61.8 retracement of the sell-off that we saw over December. So you can see that little gap I made there between the two blue lines. That will be the key area, but we could probably see some weakness also after the Chinese numbers this morning and the Chinese market being weak. So maybe we can't even get there.
Futures are down quite a bit, I think, on that data out of Asia. The sentiment starting off the week pretty low. Peter, also, of course, it's very interesting we're reaching these types of technically interesting levels, pivotal levels ahead of earnings season, which is about to get into full swing this week.
It starts today at 1300 GMT. We'll get back to that on the calendar. But before we, I wrote an earnings preview last Friday, which you can see on home.saxo. But the first chart I brought with you is actually this this whole talk about S&P 500 companies doing financial engineering in the sense that they're buying back a lot of their own shares with their surplus cash, and it's best looked at when you look at the index divisor, which is basically an aggregate term of all the outstanding shares in the S&P 500, and you can see it has had a massive decline since Q1 2011, and the Q4 numbers which we have is actually showed an acceleration. So apparently the decline in the S&P 500 was actually looks like now a buying opportunity for these S&P 500 companies, and it has been a major driver of S&P 500 strength. I'm quite curious to see how it turns out in Q1. But
interesting to see as well that the market performed so poorly despite this bid in the buybacks.
Even more interesting, right? Yeah. And then in the next chart, John, if you may, I have that in my preview, so you can go and read that. But we came off the Q3 earnings season with the most impressive revenue growth year in year since the great financial crisis. It was almost 10%, very impressive number. I think that will be the peak for this cycle. I think we'll turn down from here, starting in Q4. And I think more importantly, which I write in the preview, it's the outlook. It's management expectations, and I expect them to be much more, cautious in their outlook. And the next slide, I know it becomes a little bit of a slideshow here, but this is the earnings calendar for this week. I've just highlighted the most important ones and the link in the bottom where you can go to the full report. But Citigroup is the only one reporting today at 1300 GMT. I think a lot of focus on Citigroup. It's always the most interesting bank of the US banks because it has more exposure to the emerging markets. So I'm really curious to see what they say, what's going on in the emerging markets.
Okay, and speaking of emerging markets and emerging market demand, a lot of that has to be coming out of China in terms of the energy market. We turned lower on the major oil benchmarks on Friday, and this is a pretty interesting development. Kim, it looks like around the 55-day moving average, but also that flat line resistance you point out here.
Yeah, that's around 63 and a half, and we can't even get up there before we get this bearish candle here. You can see the black one with the long tail or the long shadow on the top. And I highlighted with a circle in the, that's the RSI at the bottom of the chart. I highlighted how it gets rejected. It seems to get rejected at 60 threshold, and that's a weakness. So it seems like it has run its course, this little correction there.
And I can't help but think that as well, the correlations are a bit hard to escape. Seems like equity bounce, oil bounce, reaching resistance both around the same time. It's very, very interesting. I think a bit hard to run and hide in terms of asset allocation and portfolio risk. And now for something completely different. I have some thoughts on Sweden. They have managed to cobble together a very ugly coalition of the centrist parties, so they're going to move forward with the government. I think the more interesting thing is housing prices in Sweden are in a free fall. The blue line showing the year-on-year percentage on the left axis below 11% now year-on-year, You can see the red line showing how this house price series just was appreciating, on the order of 200% from, I guess we call it around 2002. This is a huge risk. It's about the Riksbank having entered what I call Hotel California. You can check in anytime you like to negative interest rates and quantitative easing, but you can't never leave. And when you do, it really hurts. And I think that's what we're seeing. We talked about the Swedish krona valuation being very, very weak here. If the Riksbank is going to normalize here, it's a question of simply giving up on the era of QE and negative interest rate policies. Damage to the economy be damned. And I think that's an interesting setup here. Do they show signs of checking back into the Hotel California, or just trying to leave whatever the consequences? And that'll be the key for the outlook for the Swedish krona. Finally, let's go to our calendar for today. Not very inspiring, although we do have that Swedish CPI. Look for the reactivity around that. And the week we get off to a pretty running start tomorrow with the Brexit deal vote, which is going to fail, and then we're going to look at the number of potential. We'll talk a lot more about that tomorrow. I don't want to spend more time on that today. Lots of data points. I haven't highlighted any in red, but we'll keep you up to date as the week progresses. And that's it for now, and we'll be back tomorrow with the Saxo Bank Morning Call.